Good afternoon, folks. Andrew Schartenberg here, your mortgage engineer. Today is Friday, January 7th, and we had the all-important employment situation come out today. So that affected rates, affected them positively. Today we're seeing for mortgage interest rates, the average 30-year fixed perfect scenario loan is going to be somewhere right around 4.75% today with 0 points. And on government loans, FHA and VA, we slipped down to 4.625%, again, for the ideal scenario. Now, I want to get into the employment report and how that affected rates. Really, it was a mixed report. This comes out every month, just be aware of that, and this month we saw that payrolls, jobs added or subtracted across the United States, the consensus was that we were going to be adding about 160,000 jobs in the month of December. We really only added 103,000, so that's significantly less than what was expected. Most of those jobs were in leisure and services industry and also the healthcare industry, so that was definitely less. The unemployment rate did slip a little bit from 9.7% nationally to 9.4%, but that's kind of a mixed number, and I'll tell you why in a second. And then lastly, wages were pretty much unaffected. We are at a very anemic growth rate in wages of 0.1%, so obviously that's not a great thing. Now, with the actual unemployment rate, that's kind of a skewed stat. There's a lot that goes into it, and the reason I say it's skewed is there's a lot of folks out there that are out of work and have been discouraged for looking for jobs. So when they do the survey for this to determine the rate, you don't get some people that you should have in that number. So really that is expected to go up. So the unemployment rate really should be a little bit higher than the 9.4%. And really higher than the 9.7% it was last month. So that's unemployment for you. So really it was a mixed bag when it comes to the employment situation around the country, and overall not very good, which has greatly or positively affected interest rates. Okay, where we're going to go from there, who knows? We could see some upward pressure on rates this year. We could see them coming down a little bit. I really don't think that the economy is doing half as hot as people in the media will let you believe. I don't think we're coming out of the recession as fast as many people want to believe. So my personal philosophy is that we're going to be seeing mortgage rates stay right around where we are, if not come down. I don't think we're going to go up much more. On to the home buyer tip of the day. Today I wanted to talk a little bit about mortgage insurance. It's kind of a misconception. People don't quite understand, some first-time home buyers out there, what mortgage insurance is. You may have heard of the term PMI. That stands for private mortgage insurance, and in fact there is more than one kind of mortgage insurance out there. There's the PMI, the private mortgage insurance I just told you about. There's also FHA mortgage insurance, which is the Federal Housing Administration. And when I talk about FHA loans, that's actually a mortgage insurance program. There's also credit unions, and they have their own mortgage insurance companies. So you really kind of have three brands of mortgage insurance out there. Now you may ask, what is mortgage insurance? Mortgage insurance is an insurance that protects a lender, the people that lend you the money to buy a house or refinance, to protect them against the event of a default. So if you don't pay your mortgage, and the lender would have to take back the real estate through a foreclosure and then sell it, the mortgage insurance would cover any loss or a certain portion of their loss depending on the type for that. So mortgage insurance does not protect you, it protects the lenders. When is it required? Mortgage insurance is going to be required pretty much whenever you do not put 20% down, which is the standard. That's what most people used to have to put down to buy a home. These days there's a lot of programs out there where you don't have to put down 20%. So when you have less than 20% down, your mortgage professionals are going to be steering you into certain loan programs that may be best for you. Basically what we see around the mortgage marketplace these days is has been the standard for the last 2 years or so is the FHA loans. They allow you to put down as little as 3.5%, and they also carry the highest mortgage insurance because you're putting down so little, essentially. Then you step into the realm of the credit unions, and credit unions, the reason that they're probably in the middle of the pack and they have mortgage insurance that's fairly affordable is because credit union lending practices over the last 5 years or so, they never got out of control. They haven't suffered the losses that many conventional lenders have. So commensurately, their mortgage insurance companies that service just specifically credit unions are going to charge less. Lastly, you have conventional mortgage insurance. Conventional mortgage insurance may or may not be the best program for a borrower. It's going to depend a lot on the specific scenario, very individually based. It can be less than credit union mortgage insurance and FHA mortgage insurance. It can be more. It's going to be very dependent upon the credit scores. So you ask how long you may have to keep mortgage insurance on your loan, and you typically have to keep mortgage insurance on your loan until you reach 20% equity, meaning that the value of your property is 80% of what the that the loan amount is 80% of what the value of the property is, giving you that 20% equity stake. Usually you're going to reach that through a combination of paying down your mortgage and real estate appreciating. Obviously, we've seen values come down in recent years, but historically real estate appreciates at a rate of about 4%, and you pay down your mortgage at the same time, so eventually you'll achieve the equity stake you need to drop the mortgage insurance. Now with an FHA loan, you have to keep the mortgage insurance on for a minimum period of 5 years, even if you achieve the equity stake sooner than that. Many mortgage professionals will tell you that if you think you've achieved it sooner, come back to them and think about refinancing into a different type of loan to drop it, but if you stay in that same FHA loan, you have to keep it for 5 years. On credit union loans and conventional Fannie Mae and Freddie Mac loans, you usually only need to stay in it for 2 years, and after 2 years, if you achieve that equity stake, you can drop it. When you think you've achieved it, you're typically going to order your own appraisal and submit that to the lender or whoever services your loan, and hopefully they'll be able to drop it for you. If you ever have questions, you can seek out the assistance of a real estate professional or a mortgage professional. We're all very, very versed in how that stuff works. So that's just a quick primer on it, and hopefully you'll be able to speak intelligently about it and make good decisions when it comes to loans that you obtain. That's all for today, folks. Have a great weekend, and hopefully we're going to see lower rates here in the next couple weeks. It's my feeling that we will. Talk to you soon.